From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
3, 2. This is Money Talk for the 15th of December, 2023. Well, there are just 4 games left in the season, and the Packers are still sniffing around the playoffs. This Sunday, the Tampa Bay Buccaneers come to Lambeau, actually, and your Milwaukee Bucks have 4 home games this week. The Pistons, Rockets, Spurs, and Orlando, and just like Santa, they're all coming to town. Let's start with a Texas high school basketball player who beat his coach after being benched. He was benched for, wait for it, poor sportsmanship. Without a doubt, this next one is the weirdest story I've ever done. It comes from the science publication ARS Technical. Apparently, we share the planet with a species of worm that grows a second rear end. Oh, there's so much more. The butt develops an autonomous appendage equipped with its own antenna, eyes, and brain, and then the appendage will detach from the main body and swim away and merge with other disembodied rear ends. This is all the makings of a classic sci-fi B movie. Look for it on Netflix. A pair of convicted Kohl's food store thieves argued in court that they should face lesser charges because the stuff they stole was on sale. Where'd their lawyer go to school? The dollar store? NASA celebrated the 25th anniversary of the space station and found a missing tomato. It's been on the loose in the space station for 8 months. You'd think it would have floated by once in a while. It was described as being in an advanced state of decay. You think? It turns out that weightlessness has no effect on rotting food. And finally, Rikers Island. That's a prison in the East River of New York. The prison has opened a special unit for suspected arsonists. The kicker is the unit has no fire suppression system. What could possibly go wrong? On the podcast today, we have Dave Sandstrom, Steve Giles, and wrapping up the week, here's Joel Dresang.
Thank you, Max. Amusing as always. And an amusing week on Wall Street. We had the NASDAQ index went up 410 points this week, gaining 2.8% to close today, Friday, at 14,814. The S&P 500 rose 115 points, or 2.5%, to 4,719. The Dow Jones Industrial Average rose 1,061 points to that's 2.9% to 37,309. It broke a record high on Wednesday and broke it again on Thursday, and it was it was up today by 61 points. So that's 3 records for the Dow this week. The S&P is within 2 points of its peak all-time in January of 2022. So the markets had quite a rally that happened this week. I think the S&P's been up for 7 weeks in a row. So far this year, the NASDAQ is up a whopping 41.5%. The S&P is up almost 23%, and the Dow is up almost 13%, and that's even before dividends. Total returns, of course, are going to be even higher for those. Dave, why don't we start with you? Happy holidays from the Fed.
Exactly. I guess if you want to say Merry Christmas, that's maybe how you should have opened the meeting. And maybe this is what everybody hopes for is the Santa Claus rally. But interesting to see the markets, how they digested his commentary this week.
Right. Chairman Powell on Wednesday after the 2-day FOMC, the Federal Open Market Committee, said we're still not touching rates, which they raised them 10 times in the last year and a half to a 22-year high, and they said no mas.
And I think it's, what we're seeing this week was maybe the realization or the expectation that there's some cuts in the future. We've this year has been all about the Fed not raising rates. We never really got to that conversation about cutting. Some pundits would even suggest right now that maybe that's a little premature to even talk about cutting. But I think what you saw, the market movement this week, both in bond yields and in the stock markets, was definitely an expectation that cuts are on the way.
Well, and that's what nobody was expecting, Dave, at the beginning of the week. A lot of this market advance in November and the first half of December was really predicated on the expectation that the Fed would take a pause. What surprised everybody Wednesday was when they said, oh, not only are we pausing, but we're going to give you some rate cuts next year. And I can't remember a time when the Fed has come out point blank to tell us exactly what they're going to do. They've always been, I think, pretty open with their playbook in recent years, but to specifically say we're going to give you 3 rate cuts was the elixir that the markets used to finish what was a very, very strong week.
Does it seem to be an overreaction at all? Because, I mean, it's logical to me that if you're saying we're not going to raise rates anymore, that the next thing that we're going to talk about, because we haven't been doing anything with them for a while, the next thing we're going to talk about is lowering them.
Well, I think, Joel, there's two there's two outcomes when the Fed says we're not going to raise rates anymore. They just keep rates the same for longer, or they start to lower them. They went the next step and said we are going to lower them. We've already seen some Fed officials today backpedal a bit. They said, okay, we did say we're going to lower them, but we didn't say when. So that could mean September of next year. I mean, it could be March, but I think the Fed recognized that maybe this genie is out of the bottle, and trying to stuff it back in is going to be hard.
Are there any precautions of investors watching a Santa Claus rally and thinking, this means I should do something with my portfolio?
Well, I guess I'd say watch out for the euphoria factor, right? As there's an old saying that when everybody gets on the same side of the boat, bad things happen, right? It sinks. So I would be cautioning you to everybody to just say, oh, here we go, Fed's cutting, we're on our way. Everybody dive in head first to the stock market. I think that it's the same story we preach all the time, Joel, and that's balance is king, right? There's times we'll lean into equities or we'll lean into bonds. But right now, with such uncertainty, we're moving into an election year. There's a lot that can still happen. To suggest that, hey, we're in the clear, the soft landing is a guarantee, and the Fed's cutting rates at some point early next year, I think there's quite a bit of assumption there. So I would say proceed with caution.
Dave, we were talking about bonds before the podcast. You just mentioned this, but the 10-year Treasury, that benchmark Treasury bond, was yielding around 5% just 8 weeks ago. It started this week at 4.25%. It ended today at 3.93%. What is that telling you, and what should investors take from that?
Well, a significant rally this week, right, in bonds. And in some ways, I think Steve was kind of pointing out, too, before the show, it may be even more significant than what we saw in the stock market, really, from a kind of an admission by investors that, okay, I'm coming back to the bond market with a vengeance. I think that ultimately, Joel, it really points out the fact that 60-40 portfolio theory, right, the modern portfolio theory of a balanced, well-allocated portfolio is not dead. I mean, how many times did we see that article pop up in 2022 that, forget that type of an allocation? It's back with a vengeance, and I think that it's super critical realization right now that, hey, bonds are very important in your portfolio.
And it's also a wonderful reminder, you two, as to why it's darn near impossible to time the market. For all those investors who wanted to throw in the towel, capitulate back in October when the market was trading down, for those patient investors that were able to sit on their hands, trust their portfolio, trust the asset allocation, trust the process, they've been rewarded with a couple of really good months of recovery. And now we're going to finish the year with one of the strongest years we've seen in a long time on both stocks and bonds.
And we had a couple of economic indicators this week that might sort of fortify what the Fed is seeing in that, I mean, they're by keeping rates as high as they are, they're basically saying, we're seeing a continued slowdown in the growth of the economy, and that's what they've been trying to do, by raising the rates to slow down the inflation that was at 40-year highs a year and a half ago. We had news this week on the Consumer Price Index, which is the widest measure of inflation, and that was 3.1% year to year, which is close to what the Fed's favorite gauge was for October, around 3%. Now, that's still above where the Fed wants it long term. They want it at 2%, but it's down from that Consumer Price Index was at 9% back in June of 2022. So that's showing, that growth is slowing, but we're also still seeing growth. The retail sales were up again in November. One thing that I picked out of that was that we're continuing to see increased sales at bars and restaurants. And usually if people aren't feeling good about spending money, they're not going to go out to a bar and a restaurant unless they have to, I guess. They don't have any food at home.
Drowning their sorrows in PBR.
Well, that could be too. There's that counter effect. Yeah.
Joel, what I think is interesting about that inflation report is the real stickler still is the housing and rent number associated with that. Everything else seems to have kind of fallen in line with, more normal long-term inflation rates. But housing and rent is still that outlier. And I think largely because of the type of conundrum that the Fed is in right now by raising rates and raising mortgage rates, they've really locked up the inventory. And we don't have enough houses coming on the market. So what's going to be interesting now that we've seen rates come down, we've seen mortgage rates come down even a little bit. They're back to starting with a 6 again.
Right, they're under 7% for the first time since August.
When's going to be the tipping point for all those people that want to sell their homes? They're looking for a bigger place, new place. They want to get to a different location. What's that rate going to be that's going to trigger those people to list their homes? And that's going to be, I think, the point in which we'll get some relief on housing prices is when we get that inventory number picked up.
Now, this is all talking about a soft landing, so that we're going to be maybe experiencing the Fed lowering inflation to a reasonable rate without us going into recession. What does that mean to investors? Is that something that they should be concerned about or that they should be happy for?
Well, the yield curve right now does suggest that this economy is slowing. It's why shorter-term rates, Joel, are still yielding higher than those more intermediate and longer-term rates. The federal funds rate at 5.25 to 5.5 is certainly bigger than what you're getting on the 10-year, just under 4. But that's an inverted yield curve. It basically tells us that investors are not willing to tie up their cash for too long for fear that they won't have some liquidity when bad things start to happen. Sure. And to have that liquidity is important as we turn the corner into next year. The sooner that the Fed begins to lower rates, I think will tell us as investors what their reading of the tea leaves is. Personally, I don't think that the Fed's going to do anything for the first half of the year. If you look at the Fed dot plot that just got released, it's about, what they don't tell us is when they're going to start to lower rates, just that they expect to be 3 changes down by the end of next year. But that still isn't going to catch up the short-term rates with where the 10-year Treasury is, right? That'll push the short-term rates to 4.5, but you still got a 10-year under 4. That's still an inverted yield curve. So something has to give here, or this economy might very well be headed for some kind of recession. Soft landing or not, a recession is still a recession.
And what concerns should investors have about getting into a recession?
Well, I think unemployment goes up. Obviously, if you lose your job, you're not going to have the ability to spend the way that you had in the past. You look at credit card debt as a percentage of household income. That's been going up. U.S. consumers have this, they have an insatiable desire to spend, and they're going to continue to spend. It's the holiday season, and if it means they have to swipe their plastic and use credit to do it, by golly, they're going to do it. But at some point, they got to pay those bills. And if you start getting to a point where people are losing their jobs and unemployment goes up and hiring slows, you might get into a period where this consumer can't keep pace with the slowdown that's going to be happening.
Sure. And that can affect earnings of the companies that they're
Absolutely.
invested in. Yeah.
And Joel, that's where that balanced portfolio comes into play. And I hate to beat the drum on that throughout the podcast here, but you come into bad times potentially, and that's when you really, really appreciate that fixed income portion of your portfolio. When stocks are suffering, it gives you the confidence to stay put. It gives you the ability to continue your income stream without really missing a beat or hurting yourself in the long run. So, even when things seem fantastic and wonderful and coming up roses, making sure that you have a safe spot in that portfolio is critical.
From a timing standpoint, at the end of the year, I think it's important for investors to perhaps revisit their allocations, Dave. Are you positioned appropriately as we turn the corner into next year, and especially after the kind of run-up we had in in November and December, to circle the wagons and make sure that you are appropriately positioned for where we are as we head into 2024. The business cycle is unique. The business cycle changes all the time. And based upon where we are with rates and earnings, you need to make sure that you don't just set it and forget it, because that's not what it's about. Call your advisor. Make sure that you have had a chance to revisit things like your allocation, your mix between stocks and bonds, your mix between domestic and international. It all comes into play, and they all interplay with one another.
Is that the sort of conversations you're having now? I know you're both very busy, or is it more just sort of wrapping up things that should be settled before the end of the year?
Well, absolutely. Steve hits it right on the head. I think it's a great time to look at getting yourself set for next year and review those allocations. The other big topic you handle this time of year too is the potential for some tax loss harvesting in portfolios. If you were active in 22, when obviously there was probably a lot more opportunity, maybe you don't have anything compelling this year. But if you weren't aggressively harvesting those losses in 22, you probably still have some things you can clean up, especially in your bond portfolio. So worth a look. I mean, that's real money that you can keep in your pocket come April 15th. And I think clients appreciate that. And then I guess the last comment I would have is that conversations are just make sure that your required minimum distributions are taken care of. And if you do have any last-minute charities that you want to take care of, you're running out of time. So I'd make those qualified charitable distributions pretty quickly.
Great. Thank you both. I think you've imparted a lot of wisdom, and keep some in store for next time. And we'll listen to the podcast again next week. Thanks for listening to the Money Talk podcast.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.